Boston in the fall, how the quarters fly by. Hi, I'm Gildas Quinquis and welcome to this investment webinar sponsored by Windrose Advisors. Our topic today is international equity investing, and our guest is Jarrod Pelletier, one of the two co-founders of Westwood Global Developed Markets ex-US strategy. Jarrod and his partner Josh Byrne are long-term fundamental bottom-up investors working to assemble a concentrated portfolio of high-conviction companies in foreign markets. The strategy currently oversees $7 billion in assets under management on behalf of more than 80 limited partners. Statistics as of November 2025. Before we get started, I need to read a brief disclosure. The opinions expressed in this discussion are those of the Windrose Advisors LLC team and our guest today. The opinions referenced are as of the date of recording and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Past performance does not guarantee future results. Forward-looking statements cannot be guaranteed. Windrose Advisors LLC is an investment advisor registered with the U.S. Securities and Exchange Commission. Registration does not imply a certain level of skill or training. Windrose reserves the right to modify its current investment strategies and techniques based on changing market dynamics or client needs. The information contained in this presentation is provided for informational and discussion purposes only. This presentation is not intended to be, nor should it be construed or used as an offer to sell or a solicitation of any offer to buy an interest in any fund or any other entity, which offer may only be made at the time a qualified offeree receives a confidential private offering memorandum and related subscription documents. Jarrod, many thanks for speaking with us today.
Happy to be here. Thank you for inviting me.
We have a lot of questions to ask you, Jarrod, but before we do, I want to quickly share your background with our audience. Jarrod has over 20 years of broad investment experience. Prior to joining WGI, Jarrod was an international equity analyst from 2009 to 2015 and an investment associate from 2006 to 2009, all with Putnam Investments. Jarrod's sector responsibilities included consumer, industrials, and technology, with geographical coverage across all major international markets. Jarrod's experience also included private equity investments, running an individual analyst sleeve for 5 years, and managing a portion of a hedge fund. Jarrod received a BS in Business Administration from Merrimack College and an MBA from Yale University. Jarrod, many of the managers we work with have left large firms to start a new venture. You yourself left Putnam, a well-known asset management firm in Boston, to launch the Developed ex-US strategy with your partner Josh. Please tell us what attracted you about starting over at a new firm.
Yeah, I can give you my perspective on this. I think it's probably different for a lot of people, but I think when you join a place like Putnam Investments or Fidelity or Wellington or these large organizations, I think the value is that you're exposed to a lot of different things. And so if I think about my time at Putnam, which I greatly enjoyed and I learned a ton, you're exposed to growth investing and value investing. And then there was the blend fund, which is the style agnostic. I worked with the emerging markets fund. I worked on the dedicated consumer strategy, industrial strategy, technology strategy. We launched private equity. I was doing private equity deals, and we launched a 150-50 hedge fund. So you are just exposed. And then we had this massive fixed income division. And so you get exposure to all these things. And I think the transition for me really came out to, I have this view in life, there's a difference between what you learn and what you believe. Right, and so let me explain that. So let's say you and I get the statistics for Michael Jordan and Kobe Bryant, right? And we learn them, right? But you come to believe that Michael Jordan's the best player of all time, and I come to believe that Kobe's the best player of all time, right? Like there's a difference between what you learn and what you believe. And I think for me, having exposure to everything at Putnam, I learned so many things, but what I came to believe was that my skill set was more suited to long-term fundamental investing, where I could actually take a concentrated list of names, own them for a long period of time, and generate excess return doing that. And so I didn't want to be exposed to all the other things that I was exposed to. And so for me, Westwood and leaving a large shop to do something at Westwood was a function of I get to do things the way that I want to do them. And I've learned enough, but I believe that this is the right skill set for what I do.
Yeah, you can actually apply your own personal philosophy of investing.
Yeah, when you're at these large shops, and by the way, some people love that. Like, I'm not saying it's the right way, it's the way I think I want to do it. You're exposed to so many things, and you're being pulled in so many different directions. And you're being asked to value assets a certain way in all different strategies. And I just said to myself, I really believe in doing it this way. And so yes, exactly what you said, I'm allowed to do exactly how I feel I'm best suited to generate excess return, and that was the genesis for Josh and I to start the fund we started at Westwood Global.
Oh, that's great. Was it difficult to transition from running a very large pool of assets to a much smaller structure?
Well, I'd say it was difficult because, when we started this, we actually didn't have a founding investor, right? And so when we say that we started Westwood ground up, it was truly ground up. It was the two founders of the original business of Westwood Global, Josh and myself. We invested the first pool of capital into the fund. And so it was a bit of a shock for me to leave a huge pool of capital, right, where it was captive, to come here and say, like, we have to make this work. At the end of the day, it was us as the founding investors without a founding client. And it was really putting to work what we believe, putting up numbers. And by the way, the beauty of that is that people organically get to see who you are. You start from day one, you do what you say you're going to do. And if you can generate the excess return, or around the excess return you say you're going to, in theory, the clients that then come on with you, they've seen you and they've seen you employ your process. And so it was really special once we got there. But yes, the scare of starting something completely entrepreneurial, I think I misunderestimated that.
Yeah. Many of our own clients are entrepreneurs. I'm sure they can appreciate your point of view there.
Yes, this was truly an entrepreneurial venture.
Let's move on to the world of international equity investing. By and large, investors have been taught to go passive when investing in equities. And what is so compelling about adopting an active management approach in foreign markets?
Yeah, that's interesting, because the first thought that comes to my head when I think about passive is I think that's highly true and relevant when you think about the US. And I think, benchmark constructs are very, very different across all markets, right? US versus international versus emerging markets, right? The benchmark constructs are all very different. And I don't envy my colleagues or my peers that manage money domestically in the US. I don't envy them, because I think the theory around passive is, 35-40% of the index is tech, and the Mag 7 effectively drives most of the volatility and the performance of the US. And where I say I don't envy them, it's almost come down to, can you get this call right, which is tech and the Mag 7, or not? And if you do, great. And if you don't, it can be really tough from a relative performance standpoint. And so I actually have clients, some of the family offices we manage money for, what they've decided is, we're just going to go passive in the US and get all of our active exposure internationally in emerging markets, because I don't know how to make this call on this subset of names in the US. And so, one of the analysts on my team, Colin, he was looking up some stats, which I thought were interesting. It's even hard in the US because there's actually diversification rules where some of the managers, they can't even own enough of these names to actually be active.
The concentration has become crazy.
It's become so crazy that you're actually structurally underweight for some of these diversification rules. And, think about it. If 40% of the index is tech, in order to generate excess return, you're either making a call that's significantly below that 40 or significantly above. And if you're going to make an active bet to be overweight 40%, think about how much of your portfolio is concentrated in a subset of names. And so I answer the question to say, I do believe that passive is highly correlated with the US. In our international markets and emerging markets as well, I do believe that is where kind of active management is still. Look, this is obviously self-serving, but I still think it's highly relevant, because our benchmark construct isn't that. One of the interesting things about international markets is, if you look at our benchmark, the largest component of our benchmark is actually financials, right? And it's European financials. And think about why that is. So in the United States, you have a very sophisticated funding market, right? Whether that's, obviously very sophisticated capital markets, sophisticated private credit, private equity. You have these sophisticated funding mechanisms for the US. In Europe, as you'll know, most of Europe was built on local banks as the funding source for growth. And so that's why they're the largest part of the benchmark, because that's how Europe historically has been funded. The question I have for people is, is that true going forward? Will it be true that the funding source for Europe will still be your local domestic banks, when you're actually seeing more sophisticated, private credit's making its way to Europe, private equities, so things are evolving in Europe. And so what I feel is true is that it is a benchmark where active management is still very, very relevant, because I don't think today that the largest names in our benchmark are going to be the names ultimately that will win. So you can still find active management, where in the US, it just seems like It's about AI, it's about tech. Those are the largest constituents in the benchmark, and you have to decide whether or not that growth trajectory continues or not. I don't believe that's true of international markets.
Can you comment on where the passive capital is going then, investing internationally, compared to an active management approach?
If we back up just a second, so if you think about valuation discrepancies amongst our markets, right? So, one way to think about valuation in the marketplace today is effectively, you can take a look at what is the equity yield you derive out of investing in equities, and let's call it passive, right? So if I'm passively investing in the S&P, I'm effectively getting an equity yield that is the inverse ratio of the multiple I pay, right, for the market. So let's just use, I'll be in the ballpark, I don't have the exact number, but let's say the S&P today is on 24 times earnings, right? So the implied yield on that 1/24th is about 4.2%, right? So if I invest in the S&P, in theory, my yield is 4.2%. But if you look at that relative to what is a risk-free investment of the Fed funds rate, that's at like 4%. So there's really no differential in yield between a riskless investment with the Fed funds rate versus actually going and buying your passive index in the US for the 4.2% equity yield. That is actually not the case in Europe. In Europe, our markets are on something like 16 times earnings, right? If you were to buy the MSCI EFR index. So, that's roughly that's a 6.25 equity yield, right? But the ECB rates are 2%. Yeah. And so you're still being paid for active management, right? And so you're still being paid to actually take risk in the marketplace. Relative to the US, that's the big issue in the US is people are sitting there saying, valuations are really tough. Do I want to take an active management approach or do I want to just go passive? And so to go back to your question, in Europe specifically, or, when I say Europe, it's really the MSCI EFA, which is Europe, Japan, Australia, Hong Kong, Singapore. So when I say international developed markets, when you go passive, think about what you're buying. You're effectively buying European financials, which is the largest part of the benchmark. And then the largest country is Japan. And so that's the decision you have to make is that where I want to put my capital towards? Or do I want to take an active approach and actually take stock picking that goes across all sectors and all countries? And so I think hopefully that's a helpful answer as to why I think active really matters internationally.
Absolutely. So Jarrod, let's delve into the specifics of bottom-up investing and stock pickings. Can you share with us some examples highlighting the differences in valuations between the US and international markets and what makes those foreign stocks so appealing?
Yeah. The way we think about investing at Westwood is, we're kind of true intrinsic value investors. The word, I watch all these podcasts and people throw around the word intrinsic value all the time, and I kind of laugh because it really only means one thing, but it's become this kind of household name, right? The intrinsic value of a business is only two things, right? It says, I look at a business and I value its cash flows over some specific period of time, right? Let's call it 5 years. And then there's the sum of those cash flows, and then there's the terminal value that I want to put on the business, right? So the sum of the cash flows I forecast, terminal value, that's intrinsic value, okay? But, I see people today and they'll say, I think that this company can earn $2 next year, and I'm willing to pay 20 times for that. And so, the intrinsic value is 40. And I'm like, well, that's not the intrinsic value of the business. That's where it may trade. That's the trading value. It could earn $2 and the market may pay 40 times for it. And so, but that's the trading value versus the intrinsic value. And so I just wanted to highlight that to say, we are true intrinsic value investors, meaning we're looking at the underlying worth of the business and saying, we feel like owners of the business when we buy it, right? We're not trying to pick a multiple on some earnings number. But what I do think is interesting is this valuation discrepancy, to answer your question directly, that exists between US and international. And a lot's been said about it, a lot's been written about it. I do want to highlight one thing. There will always be a structural valuation premium for the US market versus international, right? Like we just talked about it earlier. If tech is 40% of your benchmark in the US and the largest sector in our benchmark is European financials, there is a structural valuation gap, okay? So, I kind of cringe when international managers are always pounding the table that international is cheaper than the US. It always will be. There's a structural gap. We saw some research out of one of the investment banks, though, where they did it on a sector neutral basis. So they sector neutralized the benchmarks, and international was still trading at like a 20% valuation discount to the US. And so
it is true that the U.S. markets are cheaper. I want to highlight that there is a structural valuation difference between the U.S. and international.
Right. You need to look at it like for like.
You got to look at it in a like for like. But exactly to that point, on a like for like basis, let's do that. So you can take a look at some of these international names that are very, very mirror business models to the U.S., right? Like, think about Shell versus Exxon and Chevron, right? Like mirror business models. And the valuation discrepancy between names that are just happen to be domiciled in Europe versus names that just happen to be domiciled in the U.S., meaning you could domicile them wherever you want. They're like for like businesses, and the valuation gaps are very, very wide. So, if you think about Shell versus Chevron, you're thinking about something like 10 times earnings versus 20 times earnings, right? If you think about a live example that a lot of people will see is, there's food catering companies. So, when you're at university, the universities have companies that do the catering, and there's three players in the market. There's a company called Compass Group, a company called Sodexo, and a company called Aramark, right? So if you go to a ballpark, it's usually Sodexo or Aramark. Sodexo happens to be domiciled in France. Aramark happens to be domiciled in the US. And the valuation gap is almost like 70%, right? Sodexo trades on 10 times earnings when Aramark trades on 18 to 20, right? And you can just kind of keep going down the list, right? The IT service infrastructure businesses that are in vogue right now, because the question is like, what is AI and how does AI work? And in 10 years, are you and I even sitting here? Because AI takes over everything we do, right? But you've got a company called Capgemini and a company called Accenture, right? Like big IT consultants. Capgemini probably trades on a 70% valuation discount to Accenture. That's just a function of where they're trading, where they're listed. One name that's a little bit topic du jour because there's a lot going on in the space is, there's the new weight loss drugs that are out, right? There's Wegovy versus Zepbound. There's Lilly versus Novo Nordisk. The valuation discrepancy between Lilly and Novo Nordisk is something like 120%. Lilly's valued higher than Novo. Now, could that be right based on how the market evolves? I don't know, but what the market is telling you today is that Lilly will structurally be the winner and Novo will not. And so to your point, I think it's a great question because it's not just market for market. It's actually when you get to the idiosyncratic stock picking level, we're seeing valuation discrepancies that are wide across all sectors, all countries, US versus international.
So this year has been interesting because it's one of the first few years where international markets have beaten US markets,
Maybe the first in 15, 16 years?
I know, for a long time.
Finally people care about us. Yeah, exactly.
So did international equities turn the corner? What's your outlook there?
It's not lost on me that, Liberation Day happened, right, in the US, and you saw this massive shift, these are not my statistics, but the statistics we're hearing from some of the investment banks are, you had global managers that were way overweight the US, right? And when they saw the paradigm shift of performance change for the first time in a long time, international started outperforming. You saw one of the highest flows out of domestic equities into international equities that we've seen in 3 decades, right? I mean, I don't know the numbers, but people have said it's in the magnitude of like $1 trillion in assets moved away from US into international. And I say that to say, think about what was happening at that point. So you have this idea around the trade deficit and how tariffs play out. What then ended up happening was for the first time in a long time, you saw dollar dominance start to erode, right? And so you saw weakening of the US dollar. And so all these things set up really well for what historically had been periods where international outperformed the US. And so that acutely happened, and it happened very quickly because people were so overweight one side of that trade on a global basis that you saw that move. You have very rarely seen me be the portfolio manager that goes to client meetings and pounds the table and says, now's the time to buy international. That's not what I do. What I have said to clients and what we've said to you was, if you're considering international, please consider us, right? It's less of a now's the time for international versus I think active management is ripe in international. And if you're looking at international, please consider Westwood Global. I will say, though, that I think the rhetoric is changing a bit, and a lot of the conversations are starting to occur around the valuation discrepancy is pretty wide. The yield you derive on international assets is, in theory, higher than the yield you'll derive in the US. Now, we can argue about what growth looks like in the US versus international, tech, AI, all these things. And so my hope is that this awakening of valuation discrepancy in international markets allows people to relook at international. And what we've seen this year, unfortunately, in international is you've seen a lot of active managers underperform relative. Like a lot of active managers have underperformed because that shift into international went passive, and that passive shift created a very, very, very narrow market. And so the hope that we have is that people continue to consider international as an option, but they start to branch out away from passive into active management and say, what do I want to own and who are the managers that are geared to those themes?
Right. Yeah. Passive is the first move, the knee-jerk reaction.
You have to be there. So if you haven't done the work, what do? You buy the index. And then hopefully the idea is that then branches off into, wait, what do I own passively?
Yes.
And what do I want to be exposed to?
Once you look under the hood.
Exactly. I need a car, I'll get that one, but is this the right one? Exactly.
Yeah. What has changed this year also, the dollar has started to weaken.
Yeah.
And do you think that's the start of a new trend, and is that something that would benefit foreign equities?
I wish I knew the answer to that. I'll give you my best guess, which is, it is very clear that the current administration is pushing for weak dollar. That's very clear. And there's a lot of reasons for that. Whether or not those reasons are justified, that's probably for another day and time. The answer to your question, though, is yes, weak dollar has tended to be a very good marker for performance for international assets. Think about it. My fund is priced in dollars, right? And so when I take my international names and their exposure to non-US currencies and I reprice them in dollars, there's a massive, like the tailwind for international just from weak dollar has tended to be a very good sign for emerging markets and international investing. And so could that stay? It's clear that this administration is very keen to keep the dollar weak. It's interesting. The U.S. is the reserve currency of the world, right? I think that's very clear. We all know that. And so what does that mean? That means that we have to allow foreign investment into our markets. Okay. And what does that mean? That means that we'll always have a current account deficit because foreign investment into our country will always be higher. And so, what's happening now in the economy is really hard for people to wrap their heads around because as the reserve currency of the world, we have to allow foreign investment into our market, but yet we're talking about attacking the current account deficit, right? And those things don't make intuitive sense to me. But what I can say is the outlook for a weak dollar, I think, has a lot of legs, and I think there's a lot of people that are underwriting that theme.
So that's an important consideration. Let's talk about how you build portfolios.
Yeah.
And start by telling us, you build a very concentrated portfolio, and what kind of constraints come with that?
Yeah, it's a great question. So maybe just to get really high level, when you think about your traditional portfolio manager at, one of these very large organizations that run diversified mutual funds, you think about that mutual fund being something like 60, 70, 80, sometimes 100 different holdings, right? And so that was kind of our old life, right? You worked on diversified mutual funds. There was 80 stocks created the performance of this one fund. What we're doing at Westwood is very different. We say what we run is a concentrated portfolio. And what that means definitionally for us, because concentrated is not the same for everybody, but what that means for us is we only own 20 to 31 names throughout the whole world. And so, think about what we're doing now versus what I was doing in my past life. 80 stocks versus 20 to 30, right? And so the idea around building the portfolio just has to be different. And so the reason why I love what we're doing now is what we say is we're benchmark agnostic. Like, I'm not worried about the benchmark. I don't even really think about it. I think about what are the best 20 to 30 names in the world that I can find where I have confidence and conviction in the assumptions I'm using that give me a valuation, right? That for me, I don't have to worry about what I don't own. And that's what's really freeing, I think, about running concentrated portfolios is that when you set a valuation criteria for the names that you own that's really high, it doesn't matter what you don't own. A lot of these large diversified portfolios, because they're so benchmark aware, they obsess about names that they don't own and how the performance of those names might be. When you're benchmark unaware like we are, and you have a huge hurdle rate to get into the portfolio from a valuation standpoint, if I get those names right, I should, in theory, mathematically outperform. And so when we're building portfolios, we're really looking at intrinsic value And we're saying, is the discount that we see high enough that we can own these names for the next 3 to 5 years? Because, the one thing we haven't touched on yet is I do think that is what differentiates us relative to most of our competitors, which is if you look at the turnover statistics of our fund since inception, we've turned the fund over roughly 10%. Mm-hmm. So effectively, 10% turnover equates to a 10-year holding period, right? I mean, there's just not many managers in the asset class, and you would know this, that actually take a true 10-year. Now, they'll say they're long-term, and then you look at
long-term means 18 months for them.
We had a really good friend, I won't name him, but we have a really good friend who I used to manage money with, and he worked for, call it one of the 5 largest firms in the United States, and he was head of investor relations. And so he was talking to all the underlying investors of this firm, and if I named it, it's a household name, okay? And we were having coffee with him, Josh and I, and we said to him, if you look under the hood at your underlying investors, what would you say the average investment horizon is of the average investor at your firm? And he said, no more than 6 months. Mm-hmm. So think about it. This is head of investor relations at one of the top 5 largest companies in the US. And he's saying no more than 6 months is the average horizon. And so I think that feeds into a lot of what we're talking about, which is it's not lost on me why volatility is so high in the marketplace today. The question is, like, when you're investing, the question is, over what time frame do you view this asset as overvalued or undervalued? I'm telling you, mine's a minimum 3 to 5 years. The observation has been it's been more like 10 years. And so I have to, for my clients, I have to stomach volatility and stick to my process at all times.
That's what sets you apart is you think like business owners.
Yes.
And you're looking for quality assets to own for a long period of time. So tell us a little more about the typical characteristics that you look for in a company you want to add to your portfolio.
When I say that's a question, any meeting I have, somebody will always say to Josh and I, who's my business partner, they'll always say, what's the typical Westwood stock? And I find that to be really funny because it's every meeting. And I think that's because the marketplace is used to people coming out saying, I'm a growth investor or I'm a value investor, right? And what that means is, a lot of my counterparts that we compete against that call themselves growth investors, they have these definitive factors that say, like, if a company has these attributes, it correlates to a growth stock. Or the value managers will say, if these companies have these attributes, it's a value stock. And so their picking pool is based on the attributes they think are growth or value. What's interesting about Josh and I is we'll own anything. Like, I don't come to the table with the preconceived notion of, I need the typical Westwood stock to look like this. And I think that is where we have gotten a lot of momentum in the marketplace, is that what that hopefully leads to, and it's not true of every environment, what that hopefully leads to, though, is that our portfolio can weather growth markets and value markets and volatility that happens because we're not thematically focused on just owning subsets of names that have certain characteristics. And so I love the question because when anyone asks me what's a typical Westwood stock, my answer to them is a business that the valuation criteria is where we need it to be. So the company today is trading at a discount to what we view as the intrinsic value. That's high. So let's use a simple number of 40%, right? Like, I'm looking for something like a 40% discount to what we think is the intrinsic value. And I have a significant amount of confidence and conviction in the underlying assumptions that I'm modeling to get that discount. That's the typical Westwood stock. And I think that it takes a while for a strategy like mine to show that. When we first came out into the marketplace and we called ourselves style indifferent, right? Like, we'll own anything. People are like, yeah, that sounds great. But then they want to watch to see if that's true, because do you look growth? Do you look value? Do you sway when market regimes sway? And I think once we hit our 7-year track record, I think it became apparent to people that we truly are style agnostic. And so the typical characteristics of our businesses are we have confidence and conviction in the underlying assumptions we're using, and that leads to a meaningful discount, which allows us to hold through volatility, right? When markets get euphoric or overly bearish, and have that 3 to 5 year investment horizon.
Right. Good businesses with a margin of safety.
Good business with a margin of safety, or sometimes businesses where the market thinks they're bad businesses, but they're just cyclical. Mm-hmm. Meaning at the wrong parts of the cycle, they don't look like good businesses, but through a full economic cycle, they are good businesses. And those are my favorite companies where the market thinks they're structurally broken. They're just cyclically impaired because it's the wrong part of the cycle for them to be investing in. And actually through cycle, they're very, very good businesses. Those are my favorite businesses to own.
You cover a very large universe.
Yeah.
Many countries, many stocks. So how can a small team source investment ideas in such a large universe? Describe your process a little bit.
Yeah, I always make fun of my partner and say, he's been doing this for 35 years, and so you can't really find a name he hasn't looked at or discovered.
You know the universe pretty well.
Yeah, you know the universe pretty well, and I've been in the markets for over 20 years, and we've got. I feel very blessed. We've got a team of 4 dedicated analysts that just work for our strategy. They have no other. They have no other job profile. Like they don't work for any other fund. It's just us, and I think that's probably one of our biggest competitive advantages. Like in my old life, I very much enjoyed my time at Putnam Investments, but you were pulled in a bunch of different directions because you were servicing a bunch of different accounts, right? And clients and portfolio managers. My team just works for Josh and I. And so I'm saying that to say they're focused. We're very lucky. The tenureship in our team is long. I look across my analyst group, 9 years, 7 years, 5 years, like people have been with us for quite a while. And so we've been in the markets for a long time. And so a lot of it is just institutional knowledge of our asset class. I'd say the second thing too, and it gets back to what I just said, which is a good segue, is when your hurdle rate for an investment is as high as ours is, right? Like we're looking for a meaningful discount, right? So let's just use the number again, 40% discount to the intrinsic value, right? The reason why I use that number is, let's say I found a business that had a 40% discount to its intrinsic value, and let's say I owned it for 3 to 5 years. Depending on the law of compounding, that's going to get you roughly an 11% public equity IRR, if you're right? If you're right, and the discount is real. And so that kind of avoids a lot of the benchmark. Like when your discipline on valuation is that high and you're looking for that big of a discount, it kind of takes a lot of the names that are even in the benchmark out of the opportunity set. And so it creates a more focused list of names for us to look at, because the real question for us is, when we look at the cash flows of this business, what are we using as factors to derive those cash flows? And are those factors realistic relative to what companies may have done historically or what they can do going forward? And do those factors lead to that type of valuation discount? And if they do, those are names we work on. If they don't, we move on. Because again, we're benchmark agnostic. And so I'm not worried about covering every name. If in my old life, you had to cover all the names. And so we had 25 central research analysts in Tokyo and Singapore and London and Boston. We're not covering the benchmark here. We're looking for the 20 to 30 best ideas. And so I think we can do it very efficiently with the team we have.
And you run a low turnover strategy.
Yeah.
So tell us a little more about the process of adding and removing stocks, and how many new ideas do you need?
Yeah, I have, I've been blessed to be in this industry for quite a long time, and just by way of background, I kind of didn't grow up in this industry. My father was actually a truck driver, and my mom worked at local car dealerships. So this isn't something that I grew up in, and I've been very blessed to be part of this industry for a long time. And I have friends that do various different things, and they buy the number of stocks I buy in 1 year, they buy in 1 week. Some of them 1 day, right? I mean, I always just I think life's simple math, and so I try to bring everything down to simple math. If you think about what we do. Let's say we own 20 to 31 names, called the midpoint of that 25 names. So at any given time, I'm going to own 25 names, the midpoint. And I turn the fund over at 10%. So if you just think about that mathematically, on average, I'm only buying 3 stocks a year. Mm-hmm. Like 3. You take a look at some of these hedge funds, and they're buying 3 stocks an hour, right? The algorithms are working. And so, sometimes I have friends that say to me, what do you do all day, right? Like you buy 3 stocks a year. And so what we're doing all day is our due diligence process in a single name. It can be, I'd say at the quickest, it can be 6 months. So 6 months of like heavy due diligence. Sometimes we spend a year on names. We bought a name this year where we've been doing due diligence on it for 5 years. 5 years, right? And so I think that is what my team, I think that's what my team really appreciates about our process in our firm, is that we give them the time to do the work on names, to say, I have confidence and conviction. If you spend 2 weeks working on an investment idea, how much confidence or conviction do you really have? And so when we boil it all down, so to your question, to get back to your direct question, when we boil it all down, we frame it, we say our sell discipline is effectively three-pronged, right? One, which is the best one, is companies reach their intrinsic value. We do a good job, right? And they reach their intrinsic value. But I say that to say it sounds very simplistic, but it is hard to sell winners, right? Like you get, businesses that are doing well tend to have a lot of earnings momentum. And sometimes when we sell them, we know there's going to be continued momentum post our sale, but they've reached their intrinsic value. And so our through cycle view of what this business is worth has been captured, and so we sell them. And so you have to have a heavy valuation discipline for that. The second one is, I think, equally as important to what we own in the portfolio. We have what we call a select list of names where we've done a significant amount of work on. We call it our priority watch list. We've done a significant amount of work on these names, and they're actively competing to get into the portfolio. Right, so quite literally, like that's theory. In practice, what that means is our analysts are coming to our office saying, "Why don't we own this?" Yeah. Right, so it's a name that we've done a lot of work on. We have valuation criteria that meets our threshold, and our analysts have buy ratings on these names, and they think that they deserve to be in the portfolio. And so our second sell discipline is, if a name on that priority watch list is just better than something we already own, like the risk reward skew of that name is better than what we already own, we will sell something we own to buy that, right? And so we spend a lot of time building that priority watch list and that bench of ideas. The third sell criteria, which I tell everybody this, and it's just true, it's statistically improbable to not underperform. Like, you have to underperform in this industry. There's no one that's never not underperformed. The third sell criteria is the thesis has changed and we're wrong. I am very aware, I should say we, Josh and I, we're very aware that I don't want to use the word negative. One thing we highlight as a potential risk with us is this thing called the endowment bias, right? And what I mean by that is we spend so much time working on a single idea. You spend years on an idea and
married to it.
Yeah, you think you know it well enough that, you might have an inflated view of confidence, conviction in it. And so the endowment bias is, I know this asset so well, I'm reticent to sell it, okay? And the truth is, we get them wrong a lot. And a lot of times our thesis does change. And so we kind of have an underwriting process at Westwood, which is, and it's not overly extensive, but at least once a quarter when, corporate earnings happen, our companies report, usually nothing happens and we move on. But there are times where things happen, where theses do change, or there's something about your thesis where you're like, wait a minute, I was forecasting this, why is this occurring right now? And what we have to be intellectually honest about, I think most of the job of a portfolio manager is to be intellectually honest, right? To be emotionally intelligent, right? And the idea is, if the thesis is changing and we are wrong, that is not the thesis we signed up for. And that is a sell discipline of ours. And so those are kind of the three main sell disciplines we have.
Investing in foreign markets, you and I talked about it. A lot of practical considerations come into play. In particular, foreign markets are not as deep and liquid as the US market. So what does that mean practically in, the size of your portfolio, the size of your positions?
Yeah. You're hitting on probably, I use the word maniacal. It can be a verb and an adjective, I guess. But my business partner, Josh, I say he's maniacal about capacity. He had a very successful career at Putnam, and he, rose his way up to being the CIO of all of International and Global. And I'll have this number right, but order of magnitude, I think in the pool of his strategies he was running, I think it got up to 70 billion in total assets, right? And we like to say that you don't run that, it runs you. I think that what you're bringing up is something that's really important, and I don't think a lot of managers talk about it enough, which is capacity discipline. Effectively, how many assets do you want to manage, right? And that is very correlated to your point about liquidity. I think one thing about international markets versus US markets that is uniquely different, and I think people talk about it enough, I wish they talked about it more, was the liquidity profile of the US versus international. I mean, one of the analysts on my team brought up a name the other day in the US that traded 100 million a day. Like that's like a very high liquidity profile. And I didn't even know what the company was or what it did. I'd never heard of it. Some random US company trading up. If I could get my international companies to trade 100 million a day, I mean, the liquidity profile of the US is just uniquely different than liquidity profile of international. And so I'm saying all that to say capacity discipline for us is something that is fundamental to what we do, and it is core to how we invest. And, oftentimes people ask us why our capacity discipline is kind of well below what other market participants are doing, meaning our fund today, and where we want to close it is still well below to where some of our direct competitors are managing money. And my point to them is I don't care what other people are doing. I care about what we're doing.
So what's the typical daily trading volume of one of your stocks?
Yeah, it's a great question. So we've run some analysis. What I would say to you is that if you look across Europe in general, strong liquidity for a name in Europe, somewhere around 50 million US dollars a day. So it's trading around 50 million a day, right? And that's like adequate liquidity in our markets. I just told you that there was a name in the US that I had never even heard of that traded 100 million a day, right? And so I'm just trying to highlight for people listening that there is a unique difference between the liquidity profile in the US and the liquidity profile in Europe. And I think what that means is that in theory, the theory would tell you then is your capacity discipline for managing money internationally versus the US just has to be uniquely different.
Absolutely.
And that is the core tenet. I think that is, I don't know this, but I think that is maybe what is attractive about our business and our fund to external investors is that our capacity discipline is low, and it does mean that we care more about excess return than managing a larger pool of capital.
Jarrod, current markets seem to reward unprofitable companies with weak business models. How do you navigate such a speculative environment? Do you need to adjust your process?
When I decided to join Josh and start Westwood, I have a very good friend he was a mentor of mine for years. And he said, I'm not going to give you advice because this industry is too hard. He said, but I'll tell you one thing. And the one thing I'll tell you is that in theory, you don't get fired for bad performance. What you get fired for is for changing your process when your performance is bad. And that resonated with me deeply, right? Because markets are volatile. And, I did this, I went to a college that we managed money for, and they had an investment fund, and it was amazing. There was so many students doing, like, when I was in college, investment fund, I don't even know what I was doing. But, there's like the 150 kids in this audience, and they were so much smarter than I was and asking these amazing questions. And what I said to them was, when you think about investing, if this is a job you want to do, think about your personality and think about matching your personality to what the firm's personality for investing might be in the future. And so I use an example. It was probably a bad one, but I used a basketball example. And I said, some people will watch a basketball game and they get immense amount of joy out of saying, will Jason Tatum make the next shot? Right? Like that's how they, like when they watch the game, it's like, will Jason Tatum make the next shot? Will he make the next free throw? Will he hit 3 3-pointers this game? Some people are like, will Jason Tatum have a good game? Some people will say, well, Jason Tatum have a good month of November. I am completely uninterested in that. Like, my point is, I don't know. I'd much rather say, will he have a good career? Right? And so when I think about stocks, I think about being the owner of that business and looking at it over a 3 to 5 year period. I have no idea what stocks are going to do over a single quarter. There's a lot of companies that are very good at this, by the way. I'm just saying it's not what I'm good at. And so to your point about volatility, there's a famous quote, I don't know if you've ever heard of it, it's attributed to Ben Graham. The quote is, over the short term, the market can be a voting machine. Mm-hmm. Over the long term, it's a weighing machine. And I think that's very real. I know what the quote is saying is that what actually matters to a company's valuation, it's fundamentals. Over a long period of time, what matters is the fundamentals and the cash flow your business derives. Over the short term, it can be a voting machine. Could it grow 10% or 20%? Could it generate cash flows? I mean, these businesses that do not generate cash flows, think about what you're valuing. There's nothing to value if you don't generate free cash flow. So in order to buy them today, you're making a view that at some point they will derive cash flow. And at that point, you can then value that. That's just not what we do. And so, yeah, it's frustrating in market environments like this. It's frustrating for someone like me because I look at some of these names and I say, I understand why the market owns them right now because there's momentum to the trade, but that's not an investment. And so the answer to you is, I think the best advice I've ever gotten and I use to today is do what you do and stick to your process, right? Be emotionally intelligent and don't let markets sway you. And periods of underperformance will happen. They have to happen. That's called investing. But as long as you stick to your process, I think that's where you win.
Jarrod, the quote, history doesn't repeat itself, but it often rhymes, is widely attributed to Mark Twain. Does the current period in the markets remind you of a past period, and how relevant is that for us today?
Yeah, Josh and I were having this deep conversation, and he was telling me that this period reminds him a lot of the late 90s. 99. He said this period rhymes a lot with that. And what we learned, and it's a great question because it's a great segue. What we learned is what ultimately matters is fundamentals and a business's value, right? And what ultimately matters is the market is a weighing machine, not a voting machine. And yeah, this period is very similar. We've been running, so when we launched this fund in 2015, I obviously managed through the GFC, and obviously since 2015, you've had global growth fears, China-US deterioration relationship, isolationism, deglobalization, we had Brexit, we had COVID, we had all these periods. This is probably one of the most acute periods of narrow performance I've ever seen in my career. And so, yes, history often doesn't repeat itself, but it does rhyme. I do think that, back to what I said earlier, I think you have to stay very disciplined to what you do, and you have to follow the cash flows. And that's what we're doing. But it's hard. It's hard not to get swayed by short-term moves in the market because we're only human,
Absolutely. Jarrod, you sit on the investment committee of nonprofits alongside some prominent investors.
Yeah.
What are some of the discussion topics that are happening during those meetings? What are you concerned about?
Yeah, great question. I'm just thinking about some of these committees. I said, sometimes I'll leave them unnamed, but I feel very blessed to be on some of these committees with some, I'm often wondering why I'm there. I'm I'm looking at who's in the room and I'm saying, why did they choose me to be here with them? So let me kind of break that down. What I would say is heavily debated right now, and it's kind of been in a lot of the different committee meetings I've had, is one, we talked about it, is what's the outlook for the US dollar, right? And in US dollar dominance or potentially not going forward. I think that's heavily debated. I can't have a meeting. I can't have a day go by without talking about artificial intelligence and AI. I think the hard part is no one knows yet. You have some companies where the amount of money they're spending on CapEx is like 10 times the amount of revenues they're generating. Like, to your point about unprofitable companies.
Yeah, even profitable companies are
right
out on a limb.
And there's an analyst on my team. He loves tech, and he was saying to me the other day that yes, those companies exist, but a lot of these other companies that are kind of in this AI theme, they're actually not that expensive if you really do believe in AI and its use case and what it could mean. So let me give you, for instance, on AI. I found this interesting. We had a CEO of one of our companies in Boston, and we got into this conversation about AI. And he said, here's how I think, because AI means so many things, right? And so this is something that somebody said to me that was practice and not theory that made intuitive sense to me. So think about the internet is the biggest it's the biggest diaspora of information in the world. Right? Like the AI is just, it's the biggest diversion in diaspora of information that exists. Okay? And what AI can do is it can sit on top of all of that data and it can synthesize it. Right? And that's why it's so powerful. You can ask it a question and it can take the biggest hodgepodge of data in the world and it can say, based on all that, here's an inference I have. Okay? So what the CEO said to me was, let's say you have an organization that has all of these software as a solution. We call that SaaS, right? SaaS, software as a solution. You have all these different platforms, right? And so whether that's like Salesforce.com that does your CRM system, or that's SAP that does your ERP system, you have all these different platforms. And let's say AI sits on top of them. So it's pulling the data from all of these. And let's say I'm a CFO and I say, my procurement in Asia is really good, but in Europe it's terrible. Please tell me why. And by the way, the interface is it's like a human interface. That's quite literally what you type to the AI, right? Whatever you're using, whether it's ChatGPT or Llama, it doesn't. You're asking those questions, and it can look across all your platforms, and it might come back to you and say, the reason why your procurement in Asia is significantly better in Europe is because you use 3 vendors in Europe, so you have pricing power. In Europe, you have 15 different vendors, so you lack pricing power, and so your procurement is different. And it can do it like that. Think about what the CFO used to do. They used to go to usually Gildas, who works for the CFO's office, and I'd pose you the question, hey, why is my procurement better in Asia and not as good in Europe? And you would take a week to, so it's there and it's fast. And so the question, though, becomes, what does AI do for businesses? What does that do for the workforce? And what software solutions does AI sit on top of or embed itself into that disintermediates? I don't know the answer today, and I'd be lying to you if I did, but we're spending a disproportionate amount of our time trying to figure it out.
It's
right?
the topic of the day. Are committee members worried about a bubble in AI?
I think what they're worried about is, we talked about today is, Josh talked about today being very akin to 1999, which, tech bubble, right? I think what people are worried about is there's more CapEx than the world's ever seen being thrown at this, but it's being thrown, it's not specific, right? It's all over the place. And so what I think people are trying to figure out is who wins and what does winning look like? Like sometimes we only answer the question about who wins, but we forget the second derivative to the question, which is, but what does the winning look like? And so I think that's where we're spending a lot of time. So, dollar AI, a lot of the committees are doing this exact conversation, which is US versus international, and where US dominance has existed in the marketplace for, let's just call it 15 years of US outperformance. Is that regime changing now? And then I'd probably say the last thing that is topic du jour, and I'll mention it, but I don't know enough about it to talk, but there's a lot of conversations about the future of private credit and private equity.
Mm-hmm. Illiquid assets.
There's a lot of conversations about it. I don't want to be the public equity guy giving the sob story, all right, about our markets relative to private credit or private equity, but I think
to answer that question, like all assets, you want to be careful what you buy.
Yes. Diversification has always mattered, right? And I think that for a long time, at least the 10 years I've been running this fund, we have been fighting this private equity tide because, this is not my comment. I think Cliff Aston has said it, but they call it volatility laundering, right?
It's inappropriate.
and not my words. But I think it's very real in that I think for a long time, what people wanted was less volatility in the performance stream. But is that real? Because it's just not a mark to market. Mm-hmm. And so I think you're starting to see a lot more. I mean, you've seen it with the endowments, right? I mean, you've got a lot of these endowments that went way overweight private equity. And the question is, what do they do now, right? And we've been the liquidity source for those capital calls, right? The public markets. And so I'd say those are probably the biggest themes that I run into in these committee meetings.
As always, fascinating times. And I guess the answer is stick to your process. And
I think that's the best piece of advice I've gotten this entire year is you say you do one thing, do it really well and stick to the process. And that's the one thing we say to our clients is we think we do one thing, we think we do it really well. In some periods, it will not work. But what we won't do is change what we do.
Well, this was a great conversation.
Yeah.
Jarrod, thank you so much for speaking with us today, and congratulations on all the success at Westwood Global.
Thank you for having me. I really appreciate it.
For more interviews, subscribe to our YouTube channel.